I'm Kenneth Amaduri with CrushTheStreet.com, and I'm here with Rick Rule of Sprott Asset Management. Thanks so much for being here.
Pleasure, Ken. Thank you.
I wanted to talk about speculating today, and
Great.
you consider yourself a speculator. I've heard you talk about that. And I wanted to talk about portfolio strategy. A lot of times people are trying to design their portfolio and get themselves into maybe large cap or small cap or just fit it the right way. And I'm curious, how do you get rich speculating without gambling?
That's a great question. And I think that you look at the fact that the process of speculation and the process of gambling are very different. Gambling is trusting to luck and fate, and speculating involves attempting to understand the odds or control the odds. It's a very, very different process.
Right.
Perhaps because I'm a speculator, I'm not a gambler. When I walk into a big casino in Las Vegas and look around, my instinct tells me that that great big opulent building was not built by winners. It was built by losers. And my speculative instinct tells me that when I walk in, I'm at a disadvantage to the house. A speculator looks for the place where he's at an advantage to the house. I think that's the key difference between a speculator and a gambler. A speculator looks for a place where he or she, as a consequence of some facet within their control, believe that they have an edge over other speculators or against the market at large. They're not trusting to fate, they're not trusting luck.
What is someone who's speculating? What are they going for? Obviously, people like 12% returns when you talk about large cap stocks, and over many years that can result in big gains when you talk about the compound interest effect. But what's your portfolio strategy over 30 years? If you compare it, apples to apples to, investing in 12% stocks, how do you set your portfolio up over 30 years speculate?
Well, I don't want to seem argumentative, but
I'm not trying to. I want to just...
Being 61, I would suggest that having a 12% compounded gain is anticipation is speculative.
Yeah, it's a little high, huh?
Yeah, I mean, if you...
Dave Ramsey says you get 12% in mutual funds.
Yeah, I think that's a wonderful way to sell newsletters. I think it's a poor expectation in terms of the market. But the type of speculation that we're talking about here at Cambridge House is a very different style of speculation anyway. I speculate well in extractive industries because I've been in those industries for so many years that I have a knowledge advantage compared to most of my competitors.
Right.
So I start with an edge. I have a reputational edge too, which means that people come and show me stuff that other people don't normally get to see. And I have discipline, which I think is required of a speculator. I probably look at 30 transactions for every transaction I do. Most people aren't willing to do that.
Right.
I understand my business. The natural resource-based businesses are capital intensive, and they are deeply, deeply, deeply cyclical.
Right.
What that means is, as a speculator, you are either a contrarian or you will be a victim. Most people in the resource business get the timing exactly wrong. In bull markets, when things are overpriced and their recent expectation is success, they become aggressive, precisely when they should become conservative. At market bottoms, after a market's fallen by 75% and their recent expectation is failure, they become cautious.
Yeah.
The truth is that what you need to do is be on the backside of both of those trades. That's most of what being a speculator is. The second part in this business, in the microcap part of mineral exploration speculation as an example, is that most speculators, again, misjudge the nature of the business. They think it's an asset-intensive business. But these assets, mineral properties, have a 1 in 3,000 chance of becoming a mine. The only advantage that they convey you is the obligation to spend money. A rational accountant would call these assets liabilities.
Yeah.
So the second thing you need to know, after you need to know that these things are vastly, vastly cyclical, is that the human resources are much more important than the mineral resources in these companies because they're actually research and development businesses. Yeah. So most people fail in speculation in the business, even if they get the timing right, because they misjudge the nature of the business.
Yeah, transitioning over into the junior mining sector, the Dow Jones is essentially at new highs. We've seen a correction now. And the junior mining sector has been relatively beat up over the last couple years. But going into this January 2014, I'm kind of feeling like, a little better about things. I mean, I'm seeing companies start to raise money, and I'm seeing, stocks start to go up a little bit. How cyclical do you see this time period, or do you see it as a potential bottom? And, is it? I don't want to, put you on the spot where you have to call something. But are you optimistic about what we're seeing right now, or is it?
Very, very, very optimistic. I've been in this business almost 40 years. And I can tell you with absolute certainty, and I can't tell you many things with absolute certainty, but I can tell you with absolute certainty that bear markets are the authors of bull markets.
Right.
And bull markets are the authors of bear markets. A market that has been in a protracted and deep bear market like the one we're in, where the TSXV is off circa 75%, is arithmetically 75% less risky than it was when people felt better about it.
Yeah.
That's a truism.
Right.
In terms of turning, they say history doesn't repeat, but it rhymes. What I have seen that is indicative of the fact that the market has bottomed is really two things. One, if you look at the first third, of 2013, the charts of the various companies resembled nothing so much as the topographic map of a ski hill.
Yeah.
Steep decline from upper left to lower right.
Yeah.
That was a situation where you had forced selling and you had buyer capitulation. More sellers than buyers, the stocks go down. Middle of the year, it flattened out completely. It looked like the electrocardiogram of a corpse. That's a situation where you have buyer exhaustion and seller exhaustion. Beginning of November of last year, the better part of the junior market began to tick up on low volumes. That means that they found some bids. They got cheap enough to find some bids, but the sellers were still exhausted.
Right.
That happened in 1992. It happened in 2000. Before that, it happened in 1986. That's a very, very, very good sign. This flat line bottom, and then the best issuers of the bunch. It's called It's called bifurcation. When the top 20% of the issuers in the bunch begin to head up, while the rest of them are going sideways to down.
That's interesting.
What's missing in this market for me to be absolutely able to call a bottom has been capitulation. In prior markets, you saw both retail capitulation, where you'd have a 2 or 3 week period that was farcically tumultuous, no bids, where you call your broker to sell $3,000 worth of stock, and the broker says, to who? There's no bids. So that retail capitulation hasn't been present, and issuer capitulation hasn't been present either. In issuer capitulation, the issuers say, we're not going to do $1 million survival financing.
Right.
We're going to do a $5 million financing at whatever price clears the market, because we can't continue to manage this business for survival. We have to grow it, irrespective of how the shareholders who bought it 4 years ago at 4 times the price feel about it.
Right, right.
We haven't seen those two things. When we see those things, we will have put in a bottom.
I think you kind of touched on it, but I wanted to just ask you one more question, and it's about the inflation story. And I think that's kind of what is keeping a lot of people out of it, and the retail investors that you're not seeing come in. Do you think it's going to be the inflation story that causes people to rush back into the junior mining sector? Let's call it the dumb money when it gets into that bubble phase. Mm-hmm. Or do you think it will be just prices going up, or or is it going to be something else that the junior miners are going to have to sell to get the retail investor back into junior mining stocks?
Well, what I hope happens is that half the junior sector becomes extinct.
Yeah, and that's what's happening.
That the lame, the halt, and the blind, like in 1992, get the dot and go away. With regards to the inflation story, I think what you're seeing right now is, on the part of both voters and investors, confidence in the current construct
the US
of the
economy.
global economy. I personally believe that that's misplaced confidence. But I think most people don't care. I don't think that most people study the economy particularly well.
It's holding together long enough. It's been 5 years since the
Correct.
2008 crisis,
Correct.
so
Exactly
it's too
correct.
big to fail.
So if we have something that shakes confidence, then that could ignite resource stories. But I'm not sure that would ignite the juniors. If you had a situation like 2008 where the crisis in confidence engendered a liquidity squeezes are the ugliest on the peripheries. And junior resource stocks are certainly on the periphery.
Yeah.
So junior stock promoters have to be very careful in terms of what they hope for.
Yeah.
What turned around the 2000 market was, yes, rising commodity prices, but more importantly, what turned it around was just moving off a very oversold bottom in 2000. The value buyers came in 2000. In the absence of sellers, the stock started to kick up, and then the momentum buyers came in, and it became a self-fulfilling prophecy. The thing that turned around the sector in the cycle before that, the 92-93 cycle, was better. It was a discovery cycle. The junior resource industry did something it hasn't done for 20 years. It created value. This is a market, the market that we're in right now, where everybody thinks it's such a dismal market, that will reward value creation. Sirius Resources in Australia, a 12-bagger in 4 months on a discovery. Reservoir Minerals in Canada, 22 cents to $6. Africa Oil in Canada, 80 cents to $12. The problem is the investors are begging for corporate performance, and the industry has not delivered it.
Yeah. Well, I'm hoping that with stocks at relatively, pretty decent highs, I'm hoping with that momentum, people will start looking for other sort of sectors, and people will be looking for other areas to invest their money, and potentially see an overflow into the junior mining sector.
I don't suspect that you're going to see a liquidity overflow in our sector. If people are enjoying success in the major market sectors, I think that spillover, when it comes into the speculative side, will probably go into technology, which it's done. I don't think we'll see it. I think in our sector, we need to perform independently of the big markets.
Yeah.
I think the big markets can only do us harm.
Yeah.
If they come off, we'll suffer a liquidity squeeze. If they go up, we won't benefit from their liquidity. We have to achieve of our own volition. The narrative that surrounds what we do, the narrative that existed in 2009 and 2010, is as true today as it was then. It's just perceived differently. The idea that the U.S. fiscal situation is any more sustainable now than it was in 2010 is ridiculous. The idea that the commodity thesis with regards to more and more people being born every day and those people wanting to live like you and I is as true today as it was in 2009, 2010. It's just perceived differently.
Yeah.
If all of the facts are the same period to period, but the pricing is reduced in commodities terms by 40% and in equities terms by 75%, what that means is that a recovery is inevitable, irrespective of what happens in the major markets.
Yeah, that's interesting. Well, there you have it. Rick Rule of Sprott Asset Management. Thank you so much.
Pleasure. Thank you.